and today we will be presenting the nexus between Indian corporates, banks, and mutual funds and its impact on the stability of the larger financial system. We will also discuss the case facts of Franklin Templeton and Yes Bank specifically. Next slide, please. So, as we know, mutual funds are an avenue to pool money accumulated from several investors and invest them in equities, bonds, money market instruments, etc. The investors have a common objective. There are multiple types of mutual funds, but today we'll be delving deeper into debt and equity mutual funds. Equity, of course, has a higher return due to the higher risk appetite of the investors. Debt mutual funds invest in corporate bonds, government bonds, money market instruments, and have a relatively more stable risk and return portfolio. As we all know, liquid mutual funds have the least risk and return, and equity mutual funds have the highest. We've also seen over the past 10 years that mutual fund AUM has doubled in the last 5 years as well as the 5 years before that. Moving on to the players in the market, there are banks and corporates who invest their surplus liquids into mutual funds. Mutual funds in turn invest this in a large number of securities, which includes banks and corporates, which we have focused because that is our nexus that we are evaluating in our presentation. As we can see, when it comes to liquid schemes, the concentration has been in the corporates. They have been the major investors over the years. When it comes to debt-oriented, it has been corporates, while the share of HNIs is also increasing. In equity-oriented funds, it's been retail and HNIs, since banks as well as financial institutions are low risk and hence would not want to invest as much in equity-oriented schemes. I now hand it over to Keshav.
Yeah, thank you. So let us understand the nexus between corporates, banks, and mutual funds through a specific case of Yes Bank and Franklin Templeton's story. Let me introduce you to the case participants. So Franklin Templeton Investments, whose India market debt schemes were handled by the star performer, Mr. Santosh Kamath, who had a track record of investments in lower grade bonds. Second is the Yes Capital, which is the holding company controlled by Yes Bank, co-founded by Rana Kapoor. It issued non-convertible debentures. It's basically a type of loan which they have taken from Franklin Templeton. The third is there are many corporates which Yes Capital has given loans to. We'll be discussing about one of them, which is DHFL, whose CEO is Kapil Wadhwan. So now let us understand how exactly is the money flowing from my pocket till the end in the value chain. So I, as a retail investor, is investing in debt mutual funds, which I believe are handled by professionals. Now my money is with Franklin Templeton and its manager, in order to earn higher returns, invested in lower grade bonds worth 630 crores of Yes Capital. So now it basically all depends on how Yes Capital is channelizing my money. So as a bank earns by lending the money, it has lended money to many corporates, and one of them was DHFL. So loans worth whooping 3,700 crores were given without proper diligence to DHFL. And now what happened is, why did he give the loan? Because he received 600 crores in the form of loans which were transferred to its another company, Do It Urban Ventures. It was basically owned by the Rana Kapoor's 3 daughters. Now, this is basically what is called as kickback. So now DHFL, the loan received by DHFL turned NPA, and it is alleged that Yes Bank did nothing to recover the same amount.
And so when we have a look at the timeline, which is a series of interconnected events, we see that Franklin Templeton was already under pressure because of its exposure to Vodafone debt, which had been downgraded to below investment grade in January 2020. This had caused Franklin Templeton to side pocket the exposure, which is essentially segregating the NAV of the liquid and illiquid portfolios. However, there was more bad news in store for Franklin Templeton because it had exposure of rupees 294 crores to Yes Bank's additional tier 1 debt through 3 of its debt schemes. And in March 2020, as RBI placed Yes Bank on a temporary 30-day moratorium, the information agency credit agencies downgraded Yes Bank's debt to default or near default levels. And many mutual funds took a hit and side pocketed the exposure, including Franklin Templeton. Now, because of these downgrades, as investors realized that they had invested in riskier schemes than they had thought or bargained for, they rushed to take out their money. And in order to honor these redemptions, Franklin Templeton had to sell some of their good commercial paper. However, as the COVID-19 pandemic came about, they were constrained by the tightened liquidity in the corporate debt market. And further, the lockdown was extended and the redemption pressure increased to untenable levels. And on April 23rd, Franklin Templeton announced that it would be winding up 6 of its debt schemes, which was an unprecedented move that nobody had really thought. Now, as we move further, we see that the Enforcement Directorate is now investigating the operations of Yes Bank under Rana Kapoor. He and his family members have been charged under the Prevention of Money Laundering Act, accusing them of extending loans for kickbacks, as Keshav mentioned earlier. The Karnataka HC judgment also constrained Franklin Templeton from unilaterally winding up its schemes. However, it's now being appealed in the Supreme Court. Meanwhile, Yes Bank, under its new management, has raised equity capital of rupees 15,000 crore. It is in need of more funds and is actively looking to raise more equity capital before the end of the year. Now we see that this shock reverberated throughout the financial system. The retail investors, who were already risk averse in India, they had their faith in the system shaken further. And it's not a good thing for a country like India where the participation in financial markets is already low. The shock was also felt in the equity markets, with the Sensex and Nifty dropping significantly, wiping out investor wealth. To, uh, to steady the ship, the RBI had to step in with a special liquidity facility and reduce the chances of other mutual funds winding down. Finally, while Kamat's aim was to create a market in securities which were rated below AAA, this had the opposite effect as investors shunned riskier debt schemes and particularly credit risk funds and medium duration funds and rushed to more stable AAA rated schemes. Over to Sejal now.
In lieu of the case discussed right now, India's financial regulatory authorities like RBI and SEBI took a few policy initiatives to prevent such situations in future. SEBI levied investment restrictions on liquid and overnight schemes, disallowing them to invest in instruments which have credit enhancements. And they also changed the sectoral limit cap from 25% to 20% and restricted single group exposure to 5%. This was done to protect investors from any kind of default risk associated with such high yield bonds. SEBI took steps to assess and mitigate risks at earlier stages. The first step was to form an expert committee to frame a stress testing methodology encompassing liquidity, credit, and market risks. It also revamped the risk meter to include a sixth risk level of very high, where the risk level will be recalculated every month, and each mutual fund scheme has to annually publish the complete history of the risk level changes. Finally, it has asked fund houses to ensure in-house credit assessment of assets to reduce reliance on credit rating agencies. In order to maintain enough liquidity on the schemes and as a buffer against sudden redemption requests, SEBI mandated liquid funds to hold 20% of their assets under management and liquid assets such as cash, and mandated all debt mutual funds to hold a certain percentage of liquid assets in their schemes. To bring transparency, SEBI mandated fortnightly disclosure of portfolio holdings for all debit schemes and yield disclosure of all securities in the AMC's portfolio. In other steps, SEBI imposed stricter regulations on fresh issues of additional tier 1 bonds after the Yes Bank fiasco, as we discussed, to protect retail investors by allowing only qualified institutional buyers with a minimum allotment of rupees 1 crore to invest. SEBI also allowed mutual funds to side pocket debt by allowing portfolio segregation apart from the earlier credit rating, credit risk investment on account of COVID-19, which was done to prevent investors from investing in toxic securities. A few worth mentioning initiatives that have been proposed is mutual funds to get an insurance cover for some percentage of their AUMs. Second is to build good governance practices by separating ownership from management in banks and limiting the terms of CEOs or promoters as CEOs. And RBI governor has proposed the formation of a resolution corporation to rescue stressed or failed financial institutions. Thank you.